The organizational structures of insurance companies for the national portion of your life insurance exam center on several key entities that you must be able to distinguish clearly. One of the primary areas the exam focuses on is the distinction between stock and mutual insurance companies. Stock companies are owned by stockholders who provide the capital necessary to establish and operate the company. These stockholders receive a portion of the profits in the form of dividends. Because stockholders are investors, the dividends they receive are considered taxable income. Stock companies usually issue non-participating policies, meaning the policyholders do not participate in the company profits or receive dividends. On the exam, you will likely see questions asking about the ownership of these entities. Remember that if the question mentions shareholders or taxable dividends, the answer is a stock company. In contrast, mutual insurance companies are owned by their policyholders. Instead of issuing stock, these companies are formed to provide insurance to the owners themselves. Mutual companies issue participating policies, which allow policyholders to share in the company surplus. When a mutual company has excess funds at the end of the year, it returns a portion of that money to the policyholders as a dividend. A very common exam trap is the tax treatment of these dividends. Unlike stock dividends, mutual dividends are not taxable because the law views them as a return of an overpayment of premium. If the exam asks which type of company returns excess premium to the policyholder, you must select mutual company. Another organizational structure you will encounter is the fraternal benefit society. These are nonprofit organizations that operate under a lodge system and exist for the benefit of their members. They are unique because they often have a social, charitable, or religious purpose in addition to providing insurance. To be considered a fraternal benefit society, the organization must have a representative form of government and only provide insurance to its members. On the exam, look for keywords such as lodge system or ritualistic work. If a question describes a group that only provides coverage to its own members and operates as a nonprofit, it is describing a fraternal. Reciprocal insurers represent a different model entirely. These are unincorporated groups of individuals, firms, or corporations that provide insurance for one another. Each member is known as a subscriber. The administration of a reciprocal is handled by an attorney-in-fact. This is a critical term for your exam. If a question mentions an unincorporated group that exchanges risks or uses an attorney-in-fact to manage operations, the answer is a reciprocal insurer. They are basically an exchange of indemnity agreements rather than a traditional company structure. Lloyd's of London is frequently included in exam questions to see if you understand that it is not actually an insurance company. Instead, Lloyd's is an association of individuals and groups of underwriters, often called syndicates, that provide a meeting place for individual underwriters to accept risks. They are famous for insuring specialized or high-risk ventures. If the exam asks about a group of individual underwriters that function as a marketplace rather than a corporation, you are looking for Lloyd's associations. To keep these straight during the exam, remember the phrase, stockholders get taxed, but mutuals give a refund. This reminds you that stock dividends are taxable profits, while mutual dividends are non-taxable returns of premium. Another mental shortcut is to associate the attorney-in-fact strictly with reciprocals. You will also want to watch for questions about the board of directors. In a stock company, the board is elected by the shareholders, but in a mutual company, the board is elected by the policyholders. Mastery of these structural differences is essential for passing the national portion of your insurance exam.